If you own a whole life or an IUL policy, there's a high chance it's underperforming because it was designed for the agent's commission, not for your cash value. Now, I've reviewed hundreds of these insurance policies over the last really 20 years, and I've seen too many good people lose tens of thousands, if not hundreds of thousands of dollars because of hidden scams in their policies. Now, you'll see in this video here I'm about to react to, there's 4 different whole life insurance policies that they have here. Right, now before we jump into the video and react to this, I want to talk about a few different things because people are saying like, well, aren't these all the same? And I'm here to tell you this. Not all life insurance policies, including infinite banking policies, are created equal. In fact, they're rarely ever equal. And that's the thing that I didn't know. From my own personal story, I actually had a policy that was a ripoff, right? And so we're gonna talk about that. The first example we're gonna show you here is like the policy I bought and maybe you've bought as well. Because understand that this is not term insurance. Term insurance is just death insurance. You only get paid when you die, and really you don't get paid anything. Somebody else gets paid, right? With these kind of policies, whether it's whole life or index universal life, variable universal life, any kind of universal life for that matter, these policies have a death benefit, but they also have this tax-free savings account called cash value. So whenever you see in this video, he talks about cash value, right? He's talking about this tax-free savings account inside of it. Now, when they talk about this base, what they're really referring to is they're talking about this whole life insurance, because normal whole life insurance is different than other insurances. Whole life insurance has front-loaded costs. You pay most of your insurance costs up front, and then it gets cheaper over time. This is different from like universal life, which we're not really talking about here. Universal life is like buy term, invest the difference, where it starts out cheaper, but gets more expensive over time, right? Which is one of the reasons why so many people are getting rid of these right now, because they realize it's not growing as much as they thought because the stock markets aren't doing as well as they thought. So this 100% base is like what I bought here. So you'll see here, they're paying $50,000 a year. That's highlighted in yellow on the left-hand side here. Notice the total cash value. This is the tax-free savings account is 0. Second year, same thing. They paid $50,000, 0. Third year, they paid $50,000. There's now $25,000 in here. This is very similar to what I had. Now, it wasn't with this specific insurance company. It was with another one, but they're all kind of the same. Usually the first at least 2 years, there's no cash in here. All of it goes to pay for the insurance cost, which also pays for the insurance agent's commissions. Just so you're aware, when people ask me, well, how does an insurance agent get paid? They always seem to hide it from me. Here's the easy answer. They're paid a percentage of the insurance cost coming out. That's how they get paid, pure and simple. So if you're putting in $50,000, you have 0 cash value, guess what? They're getting paid a percentage of that $50,000. This is why it's the normal strategy to do. This is why so many people, even like Dave Ramsey, is right when he says these are a ripoff, because they are a ripoff, especially early on. And you'll see here, like you pay $150,000, have $25,000 in here, that's it. Well, this is why I lost my policy in 2008. I bought one in 2006. When 2008 rolled around, I didn't have the cash to fund it anymore. I had no cash value. I lost my policy. It was a ripoff. I did find later you could do these other options we're going to talk about that actually make it better. Now notice here, even by year 12, you paid in $600,000, highlighted in yellow, you finally have $624,000. You finally got past the point where you have more than what you paid in. Just so you know, year 12 is good. And I know exactly which insurance company they're using. They're using pretty much the same insurance company for all of these except for the last one. But that's really good. That's actually good. Most of the time, it takes at least 15 to 17 years to break even. I saw one policy that somebody sent me that actually took 39 years before they could break even. 39 years. That's ridiculous. If you have this kind of policy, you need to pause this video right now. You need to go reach out to us at moneyripples.com and book a free consultation right now, because these are an absolute ripoff. They will suck all your money dry. Not worth it. You don't have to do it this way. In fact, I asked the agent if I could do it differently. He told me no, all because he told me, he said, Chris, I said it that way because I couldn't afford to cut my commissions. There's the answer, right? So I do not like this kind of design at all. All right, let's move to the next one, that 30-70 split. All right, so I'm not gonna spend a ton of time on these other ones, but I do wanna show you what's possible. Here's a different split. They say 30-70 split. Really, this is where you notice you pay in $50,000, year one, $33,000. Really, it's a 2/3, 1/3 split. So 1/3 going to cost, 2/3 to cash. Just so you know, there's no 100%, like where it all goes to cash. That doesn't exist. There are some people out there, even on YouTube and social media, saying this is the best way to go. And they'll try to explain why, but they really don't. And the reason is they'll say, hey, this is better for infinite banking, but it's not exactly the best, right? So notice that's $33,000. Even by year 20, $1.6 million after you paid in $1 million. Watch this though. But notice this other one. This is more like what we design, closer to it. We can actually do ways to get a few more extra bucks out of it. But $50,000, look, year one, 40,000 bucks, not 33,000, 40,000. You might think, well, is that better? The answer is yes. You just saved yourself $7,000 of extra insurance costs. Really, you're saving 40,000 from that first bad example, right? And look, by year 5, you break even at 250,000. Most infinite bankers will say you break even by year 7. You could do it by year 5. But you see here, as it skips down, you got 1.64 million. So it's still more cash than what you paid in the other one. And you actually have more death benefit too. And here's the cool thing, your minimum is lower. So the minimum here is like 8,600 bucks. So you only have to pay 8,600, but you could pay up to 50,000 in this example. This is a 35-year-old. Again, this varies with every person, and that's why you want to book a call with us to find out what that looks like. I'll show you one more because this is a big one that on YouTube has been a big myth. The 90-10 split, where 90% of your cash goes in, 10% comes out in cost first year. Just that first year, you can't tell if it's the better or not. Watch. So this one, look, 50,000 goes in, you got 45,000 day one. That's amazing, isn't it? Even look at year 5, 256,000. You even have more by year 5. And people say, well, obviously this is the better option. Not so fast. Not so fast, because I tell people this all the time because it looks better now, but unfortunately it's not, because this particular company, when they do this is Mass Mutual, just so you know, when they do it this way, even their boring product will beat this one out in the future. You'll have more cash later on. All they're doing is reducing costs up front, but then they tack them on the back end more. So it looks good in those first 4 or 5 years, but by year 6, you actually start to lose compared to the other example. Now you look out here, look at year 20, you've got $1.48 million, but remember we had $1.64 million on the other one, and it has a lower death benefit. So you had more death benefit with that 1783 split, which is basically more like the max ROI method we have, versus this 90-10 split didn't end up making more money down the road anyways. Even by year 10, there was still less money. So just so you're aware, there are smoke screens here. There are things you have to be aware of. It's not just as simple as looking at, oh, year 1, more cash, that's better. It's not always that easy. So this is why you want to book a call with us. So again, in the description below, you can go ahead and book a time, talk to somebody, say, what does this look like for me? It doesn't have to be 50,000 a year. If it can be at least 5,000 to 10,000 a year, that's sufficient. And just so you know, you're not required to have to make 5,000 or 10,000 a year payments either. So again, reach out to us if you want that free consultation. And especially if you've got one of these already, we can actually look to see apples to apples at whether you should keep it or maybe you should get rid of it and replace it. We had one client where he made me do this. And I said made me, okay, he asked me, but he asked me very persuasively because I wasn't going to do it. I said, you know what, you got other infinite banking policies. They're like 6, 7 years old. Probably shouldn't mess with them. It's like, Chris, can you double check anyways? When I did, literally in 20 years, they would have $2.25 million more with our policy than with the old one that they used to have. Needless to say, not only did they have more death benefit, they had more cash value. They said, Chris, we need to make the change now. We did, to save them $2.25 million over the next 20 years. What could you do with $2.25 million? Quite a lot, right? So again, reach out to us in that description below.